For most homeowners, mortgage payments are a constant, and although the thought of paying off your mortgage may be an enticing one, it may not be the right financial decision for you. Peter Sashaki from Everything Financial joins us now with more. Good morning, Peter. Great to see you.
Nice to see you, Jason. Good morning. How you doing?
I'm great. It seems counterintuitive, Peter, but there are drawbacks of paying down your mortgage faster.
Yeah, there are drawbacks. There's better ways, let's put it that way. But imagine this. A mortgage is an investment. It's an investment in yourself, in your home, but it's still an investment. Mortgage rates right now about 1.5 to 2, maybe even 3%. Some of the newer rates are a little bit higher. But think about it. Would you really go do an investment for 2%? Would you invest in anything that you're only going to earn 2, 2.5, or 3? Probably not. So putting money into your house is the same thing. You're investing and only getting a 2.5% return. Not really a smart financial decision.
All right, let's talk details now. When does the math say when it comes to making those financial decisions? How do people make those decisions?
Well, the key in this and paying down your house is what's the smart financial decision? You're right there. And how are you going to earn money? So look at this. Put your money instead into a TFSA. And there's some stats we have that you could extend your mortgage stay to 30 years instead of 20. But the key is you have to be disciplined. Take the extra money and put it in a TFSA. And even if the TFSA earns 6%, at the end of 5 years, you're going to have a considerable more amount of money and put that against your mortgage payment. And over the life of a mortgage, if you kept doing that philosophy, you could really, really pay down your mortgage way faster through the growth of your TFSA, which is tax-free. So go conservative and use a number of about 6%. And if you're making that kind of money in your TFSA or more, then it's a really smart decision, especially with mortgage rates still so low, despite the fear you're hearing that you're going to have to run into the street scared because mortgage rates are going through the roof. They're not there yet.
Peter, are there any other benefits of putting those extra funds in a TFSA?
Well, it gives you a little more freedom and a little more safety. You have an emergency fund. You have a retirement fund that way. You're not paying any tax, which is great, but it gives you more choice. What if you need the money for something? If you put it in your mortgage, not that that's necessarily a bad thing because you're paying down debt, I know, but it's low cost debt. But what if you needed the money for a home emergency or a family emergency? At least in your TFSA, it's there. Or what if, gosh forbid, you have to pay a lot in taxes? Then you can always use your TFSA to help out with your RSP and create some more tax deductions. TFSAs used well are a great thing. They give you lots of options, and helping pay down your house early is just one of those options.
And is this a possibility for everyone?
Anyone can do this. If you have room in your TFSA and you have a mortgage, you fit, you can do it. But just remember, don't put into a TFSA earning 0.25% in a daily interest account. Kind of a waste of time. Look for a TFSA with your registered financial planner and your portfolio manager that can earn a good rate of return over the long term. Again, 6% more, hopefully, and make the interest work in your favor, and it's tax-free.
Finally, Peter, you already kind of mentioned this. Mortgage rates are expected to increase. So what advice do you have for people? Should they try to refinance before rates increase?
No, you're just causing yourself more fees, putting more money in someone else's pocket, and it's not your pocket, and remember, it's your money. There's no point in running fearful, because that's what sells is fear. I said, if you're in a variable mortgage or a simple interest mortgage like a line of credit, you could have, especially variable, you could have 6 bumps in mortgage rates right now. 6. It's going to take a while to get 6 of them. And you would only be maybe at the rates we were at pre-COVID. They're still not going to be that high. The problem is we've got into this false sense of such an artificially low mortgage rate that if we hear about a bump of 0.25%, everyone acts like the sky is falling. Rates can afford to go up and people will still be okay. There's no point in refinancing though, especially if you got 4 years left, causing a fee that really you're not going to have to pay. So why put that upon yourself?
Always makes sense, Peter. Thank you so much for your advice. Talk to you next week.
Thanks, Jason. I try to make sense sometimes. Have a great week.
Peter Sashaki from Everything Financial.